Hello everyone, welcome to the 205th episode of me learning how to trade in Forex. So in the last episode we went through 3 articles in the Forex Trading Strategy and Education series. So how currency trading works, what's a currency pair, major, minor and exotic examples, and what are pips in Forex trading and what is their value. So didn't make that much notes on them. Basically, certain currency pairs will have more volume during certain sessions. A direct quote is what amount of domestic currency is needed to buy 1 unit of the foreign currency, whereas the indirect quote is what amount of domestic currency is received when 1 unit of foreign currency is sold. So AUD, USD and USD CAD are known as the commodity currencies because both Canada and Australia are rich in commodities and both countries are affected by their prices. I should have said both currencies maybe, but the currency markets open on Sunday night and close on Friday 5 PM US Eastern Time. A pip is the smallest whole unit of measurement of the difference between the bid and ask spread in a foreign exchange quote. And that's it. So next one is why interest rates matter for Forex traders. Why interest rates matter for Forex traders. Date is the 23rd. Okay, so why interest rates matter for Forex traders. Interest rate changes made by any of the world's most influential central banks can have a major impact on the foreign exchange market. These rate changes usually are a response to economic indicators observed throughout the month. They potentially can move the market immediately and with full force. Interest rate changes are usually a response to economic indicators observed throughout the month. They potentially can move the market immediately and with full force. So they can potentially move the market immediately and with full force. Surprise interest rate changes can have a substantial impact on traders. Therefore, it's important to understand how to predict and react to them in your quest to secure profits. Key takeaways: Forex markets track fluctuations in the exchange rates of currency pairs. The relative difference in the interest rates of countries is a primary factor in exchange rate movements. Interest rates can often be predicted using economic models. However, news and surprise announcements can have an immediate impact on rates, which in turn can affect Forex prices. Unexpected changes in Forex rates can present traders profit opportunities. So interest rate basics. Interest rates are crucial to day traders in the Forex market. That's because the higher the rate of return, the more interest occurred on currency invested and the higher the profit. The higher the interest rate, because the higher the rate of returns, the more interest occurred on the currency invested. The more interest occurred on the currency invested, accrued, I don't even know how to say that, on the currency invested, and the higher the profit, and the higher the profit. Of course, the risk in a strategy involving interest rate change is currency fluctuation, which can dramatically offset any interest-bearing rewards. While you may always want to buy currencies with high interest rates, funding them with currencies with low interest rates, such a move is not always wise. Interest rates should be considered carefully, as should any news release about any interest rates from central banks. How rates are determined: each central bank's board of governors controls the monetary policy of its country and the short-term rate of interest at which banks can borrow from one another. The central banks will raise rates in order to curb inflation and cut rates to inject money into the economy and encourage lending. Each central bank's board of governors controls the monetary policy of its country and the short-term rate of interest which banks can borrow from one another. The central banks will raise rates in order to curb inflation and cut rates to inject money into the economy and encourage lending. Central banks will raise rates to curb inflation, and cut rates to inject money into the economy and encourage lending. Relevant economic indicators may provide an idea of actions the central bank may take. Some important US economic indicators include personal consumption expenditures price index, consumer price index, consumer spending, employment levels, subprime market, housing markets. Important economic indicators which may provide an idea of actions a central bank may take. So, personal consumption expenditures price index. Personal consumption expenditures price index. Consumer price index, consumer spending, employment levels, subprime market, housing market. Predicting central bank rates. Data from these and other economic indicators can help a trader project and prepare for an interest rate change. Healthy economic activity can mean rates may be left unchanged. If the economy is too strong, the central bank may raise rates. On the other hand, weakness measured by indicators can portend a rate cut to encourage borrowing. Healthy economy can mean rates may be left unchanged. If the economy is too strong, the central bank may raise rates. If the economy is weak, the central bank may cut rates to encourage borrowing. If the economy is too strong, may increase rates. It's also possible to predict an interest rate decision by taking note of major announcements and analyzing economic forecasts. Major announcements from central banks leaders can provide vital information about interest rate moves. They shouldn't be overlooked in sole favor of economic indicators. When the board of any of the 8 major central banks is scheduled to talk publicly, traders can glean insights into how a central bank views inflation and therefore actions it might take. For example, on July 16, 2008, Federal Reserve Chair Ben Bernanke gave his semi-annual monetary policy reports to the House Committee on Financial Services. At a typical session, Bernanke reads a prepared statement on the US dollar's value and answers questions from committee members. Bernanke, in his statement and answers, was adamant that the US dollar was in good shape and that the government was determined to stabilize it, although fears of a recession were influencing all the other markets. His statement was widely followed by traders who took it as a positive sign that the Federal Reserve would raise interest rates. This perception resulted in a short-term rally on the dollar in advance of the next rate decision. The Euro-USD declined 44 points over the course of 1 hour, which is good for the US dollar. The Euro-USD declined 44 points over the course of an hour, which is good for the US dollar. So you would need less USD to get 1 euro. Yep. The move resulted in a $440 profit for traders who acted on the announcement. Oh, damn. So, major announcements can provide vital information about interest rate moves. So, major announcement from central bank leaders can provide vital information about interest rate moves. They shouldn't be overlooked in sole favor of economic indicators. When the board of any of the 8 major central banks is scheduled to talk publicly, traders can glean insights into how bank views inflation and therefore actions it might take. Traders can glean insights to how a bank views inflation and any actions and the actions it might take. At a typical session, Bernanke reads a prepared statement on the US dollar's value, answers questions from committee members. Was adamant that the USD was in good shape and that the government was determined to stabilize it, although fears of recession were influencing all the other markets. So the candlestick chart shows the Euro-USD declines in response to the Fed's monetary policy testimony imaged by the Euro-USD declined 44 points over the course of an hour. So we got 13, 14, so each one of these is an hour. Candlestick charts, we got the black candle, I think that's a red candle basically. So the red candle, the opening price is, oh no, the closing price is below the opening price, so that's the opening price, that's the closing price. So it dropped from there to there. Lowest is here. And 44 is from, I'm assuming 1.5799 minus 1.5843. Yeah, which gives you 44 pips. So over 1 hour it declined 44 points. And they went back up again slowly. When was this statement, what time was it made? Was it made around 2 o'clock? Or was it 1? Because it looks like there's still, to be fair, I can't really say where this, because I don't know what the candle before this one is like, so yeah. Anyways, forecast analysis. The second way to predict interest rate decision is by analyzing forecasts. Interest rates moves can be anticipated. As a result, brokerages, banks and professional traders will already have a consensus estimate of what the rate may be. Traders can take 4 or 5 of these forecasts, which should be very similar, and average them for a more accurate prediction. Interest rate decisions can be predicted by analyzing forecasts. Brokerages, banks and professional traders. Brokerages, banks and professional traders will will already have a consensus estimate of what the rate may be. Can take 4 or 5 of these estimates and average them for a more accurate prediction. Why 4 or 5 though? I mean, is it possible to do your own analysis on this? How to predict interest rates? Don't know, I have to watch a video or something and see how the other parties analyze it, and I'll see if I can do my own analysis one day maybe. So, when a surprise rate change occurs, no matter how good a trader's research or how many numbers they've crunched before the rate decision is made, they may be still caught off guard by a surprise rate change by a central bank. When this happens, a trader should understand in which direction the market will move. If there is a rate hike, the currency will appreciate. This means that the traders will buy. If there's a rate cut, the traders will probably sell and buy currencies with high interest rates. When a surprise rate change happens, traders should understand in which direction the market will move. There's a rate hike, the currency will appreciate. So if the interest rate goes up, currency will appreciate. If the interest rate increases, the currency will appreciate. If the interest rate decreases, the currency will depreciate. So traders will buy. So traders will probably sell and buy currencies with higher interest rates. Once a trader has determined the market movement, it is crucial to do the following. Act quickly. Markets tend to move at lightning speeds on a surprise because all traders vie to buy or sell ahead of the crowd. Proper preparation and fast action can lead to a significant profit. Watch for volatile trend reversal. Traders' perceptions may rule the market at first release of data, but then the trend will most likely reverse back to its original path. Once the market movement has been determined, do the following. Act quickly. So market tends to move at lightning speed on a surprise because all traders vie to buy or sell ahead of the crowd. Market tends to move quickly because all traders vie to buy or sell ahead of the crowd. Proper preparation and fast action can lead to a significant profit. Proper preparation and fast action can lead to a significant profit. Watch for volatile trend reversal. Volatile trend reversal. Traders' perceptions may rule the market at the first release of data, but then the trend will most likely reverse back to its original path. So, traders perceptions may rule the markets at the first release of data, but then the trend will most likely reverse back to its original path. The following example illustrates the above steps. In early July 2008, the Reserve Bank of New Zealand has an interest rate of 8.25%, one of the highest of the central banks. The rate had been steady over the previous 4 months, and the New Zealand dollar was an attractive buy for traders due to its higher rate of return. In July, contrary to all predictions, the bank's board of governors cut the rate to 8% at its monthly meeting. While the quarter percentage drop seemed small, Forex traders took it as a sign of the bank's fear of inflation. If they cut rates, it means the economy is starting to weaken. Fear of inflation immediately withdrew funds or sold the currency and bought others, even if those others had lower interest rates. The NZD USD dropped from 0.7497 to 0.7414. So USD strengthened against the NZD because it takes less USD to get one NZD for a total of 83 points or pips over the course of 5 to 10 minutes. Those who sold just one lot of the currency pair gained a net profit of $833 in a matter of minutes. As quick as the NZD USD dropped, it was not long before it reversed and continued its upward trend. It did not continue falling because despite the rate cut, the NZD still had a higher interest rate at 8% than most other currencies. As a side note, it's important to read actual central bank press release to determine how a bank views future rate changes and decisions. The data in a release can spur a new trend in the currency after many short-term effects from a surprise change have taken place. So that's the drop. As a side note, it's important to read actual central bank press releases to determine how a bank views future rate changes and decisions. Read the actual central bank press release to determine how a bank views future rate changes and decisions. The data in this release can spur a new trend in the currency after any short-term effects from a surprise change have taken place. The data in a release can spur a new trend in the currency. Data in a release can spur a new trend in the currency after any short-term effects from a surprise change have taken place. Why are interest rates important to Forex investors? They're important because, for one, some foreign currencies pay interest. Secondly, interest rate changes affect exchange rates. Changes in exchange rates move the Forex market, and that gives traders opportunity to make money. So they're important because some foreign currencies pay interest. Secondly, interest rate changes affect currency exchange rates. So interest rate changes affect exchange rates. Interest rate changes affect exchange rates. Changes in exchange rates move the Forex market, and that gives traders opportunity to make money. What is a central bank? A central bank is the organization with primary responsibility for its nation's economic prosperity, monetary policy, financial system health, and the stability of its currency. What's a central bank for the United States? The Federal Reserve is a central bank in the US. It's considered the most influential central bank in the world. Its Federal Open Market Committee meets 8 times a year. At these meetings, committee members review economic conditions and decide whether monetary policy actions are necessary. The announcements that come out of the Federal Open Market Committee meetings are closely watched by traders. The bottom line, following the news and analysing actions of central banks should be a high priority for Forex traders. As central banks determine their region's monetary policies, currency exchange rates tend to move. As currency exchange rates move, traders have the ability to maximise profits. Profit potential exists not just with interest accrual from carry trades, but also from actual fluctuations in the markets. Through research analysis can help a trader take advantage of surprise rate moves when they inevitably happen. Thorough research analysis can help a trader take advantage of surprise rate moves when they inevitably happen. Interest rates done. Next one. So what is a central bank? Every nation or region has a central body that is responsible to oversee its economic and monetary policies and to ensure the financial system remains stable. This body is called a central bank. Unlike commercial investment banks, these institutions aren't market-based and they are not competitive. Many central banks are concerned with inflation, which is the movement of prices for goods and services. They keep inflation in line with interest rates. Central banks keep inflation in line with interest rates. For instance, a central bank will increase interest rates to slow growth when inflation exceeds its targets. Conversely, it lowers interest rates to spur growth when inflation drops below the bank's targets. Central bank will increase interest rates to slow growth when inflation exceeds its target. A central bank will decrease interest rates to spur growth, to encourage growth when inflation drops below its target. The majority of the world's central banks are independent, yet answer to their federal governments, and therefore the general population. The majority of the world's central banks are independent, yet answer to their federal governments, and therefore the general population. This article looks at several of the world's most influential central banks, their mandates and their structures. Central banks are responsible for economic and monetary policy as well as the soundness of the financial system. These institutions set interest rates and control the money supply of a country. The US Federal Reserve is one of the most powerful central banks in the world. The European Central Bank oversees the policies of the Eurozone. Other notable central banks include the Bank of England, the Bank of Japan, the Swiss National Bank, the Bank of Canada, and the Reserve Banks of Australia and New Zealand. US Federal Reserve System, Fed. The Federal Reserve, commonly referred to as the Fed, is a central bank of the United States. It is probably the most influential central bank in the world, with the USD used for approximately 90% of the world's currency transactions. The Fed's sway has a sweeping effect on the valuation of many currencies. The Fed is responsible for the effective operation of the US economy while keeping the best interest of the public in mind. In accordance with its 5 key functions, the Fed promotes monetary policy, maintains financial stability, preserves the soundness of individual financial institutions, promotes the safety of payment and settlement systems, and oversees consumer protection. The Federal Reserve is responsible for the effective operation of the US economy while keeping the best interest of the public in mind. In accordance with its 5 key functions, in accordance with its 5 key functions. The Fed promotes monetary policy, maintains financial stability, preserves the soundness of individual financial institutions, promotes the safety of payment and settlement systems, promotes the safety of payments and settlement systems, oversees the consumer protection, The Fed is made up of 3 distinct groups. The Board of Governors. This group works independently of the US government but reports directly to the Congress, which oversees the Federal Reserve. The 7 governors or board members are nominated by the US President and confirmed by the US Senate. The board is responsible for maintaining the Fed's goals. Each board member serves on the Federal Open Market Committee. The Federal Reserve Banks. This group is made up of 12 regional banks that oversees various parts of the country. They are located in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. The banks are supervised by the Fed's board. The Federal Open Market Committee. The Federal Open Market Committee is what the FOMC and is made up. The Federal Open Market Committee is made up of the board members plus the 12 presidents of the reserve banks. So the board members, which is the Board of Governors, plus the presidents of the reserve banks. The chair of the FOMC is the head of the Federal Reserve Board. The FOMC meets 8 times a year when it reviews the economic conditions, the stability of the financial system, and the monetary policy. The Fed is made up of 3 distinct groups. The Board of Governors, what's governors? Why is that wrong? Governors, the Federal Reserve Banks, the Federal Reserve Banks, and the Federal Open Market Committee. The Federal Open Market Committee. European Central Bank. The European Central Bank was established in 1999. The Governing Council of the European Central Bank decides on changes to monetary policy. The Council consists of 6 members of the Executive Board of the European Central Bank, plus the governors of all the national central banks from the 19 Eurozone countries. As a central bank, the European Central Bank does not like surprises. Whenever it plans to change interest rates, it generally gives the market ample notice by warning of an impending move through comments on the press. The bank's mandate is to keep prices stable and ensure that growth is sustainable. Unlike the Fed, the European Central Bank strives to maintain the annual growth in consumer prices below 2%. As an export-dependent economy, the European Central Bank also has a vested interest in preventing excess strength in its currency because this poses a risk to its export market. The European Central Bank's Council meets bi-weekly, so every other week. Policy decisions are generally made at meetings where there is an accompanying press conference. These meetings happen 11 times a year. The European European Central Bank does not like surprises. So it generally gives the market ample notice by warning when of an impending change to interest rates through comments to the press. Banks' mandates to keep price stable and ensure growth is sustainable. The European Central Bank's mandate is to keep prices stable and ensure growth is sustainable I like the Fed. The European Central Bank strives to maintain the annual growth in consumer prices below 2%. The European Central Bank strives to maintain the annual growth of its economy. The European Central Bank strives to maintain the annual growth of the European Central Bank strives to maintain the annual growth in consumer prices below 2%. As an export-dependent economy, the European Central Bank also has a vested interest in preventing excess strength in its currencies because this poses a risk to its export market. So, as an export-dependent economy, the European Central Bank has a vested interest in preventing excess strength to its currency because this poses a risk to its export market. European Central Bank's Council meets bi-weekly. Policy decisions are generally made at meetings where there is an accompanying press conference. These meetings happen 11 times a year. I'm going to leave this episode here then. In the next video, we're going to carry on with the central banks with the Bank of England. Peace.